Interest is up and the stock market's down, but are we headed into a recession? I'm Matt Atwood, a CFP at TimeWise Financial, and today I want to dive into what's really going on behind the curtain. We are going to discuss the current state of the market, why there have been so many layoffs, and how much you should have saved for retirement. With that being said, let's jump right in. Last year, investors had a tough year, with the S&P 500 down more than 18% and costs of borrowing money jumping to their highest levels in over 20 years. This, combined with a sharp jump in layoffs and inflation, has left many wondering what is in store for 2023. So let's take a look, starting with, are we headed towards a recession? Historically, a recession has been 2 consecutive quarters of negative economic growth, which we saw in Q1 and Q2 of 2022. But since then, the economy has gotten back into gear and grew by 2.9% in Q4. This means we are not in a recession, but are we headed towards one? The recent layoffs announced by companies like Amazon, Meta, and Microsoft have dominated headlines and stoked the fearful flames for what lies ahead. The good news is that even after this recent bout of layoffs in the tech industry, unemployment is still historically low. Unemployment in the US has averaged around 5.73% over the last 70 years and is currently only around 3.5%. This is good news, as long as people have paychecks, they tend to pay their bills, go out to eat, and buy new TVs at Best Buy. All these activities go to stimulate the economy. And as long as people have money coming in, the music continues to play and the economy continues to expand. These recent layoffs seem to be isolated to industries that got out over their skis, like tech and real estate. Companies like Amazon and Redfin had record years in 2020 and 2021, when the market was being deluged with economic stimulus. The leaders of these companies falsely assumed that things could only go up from where they were and made some bold predictions when forecasting into the future. Companies like Amazon saw a huge surge in demand and hired over 550,000 new employees during the pandemic. Once reality set in and folks were able to return to Target and Walmart, Amazon's demand returned to normal, and they were now overstaffed. This left them with no choice but to lay off a lot of their recent hires, as their forecasts were admittedly too ambitious. The good news is those industries that were hit hardest, like airlines and cruises, are now itching for employees, and part of the reason unemployment is expected to stay low. This is a tailwind to the overall economy and a significant indicator that a recession may not be so likely. Additionally, many have expressed concern about inflation, wondering, with everything getting so much more expensive, how could we not go into a recession? The good news is that inflation is quickly subsiding, as inflation is down 31% from its June 2022 highs. The Fed stepped in last year and aggressively raised interest rates. This successfully served to cool the white-hot real estate and auto markets and have been instrumental into returning these industries to normal. If we would have spoken a year ago, we would have said it seems like a bubble is forming, with bidding wars on homes and cars selling well over MSRP. Thankfully, the increase in cost of borrowing money has corrected the course in these industries. Additionally, these higher interest rates serve to reward investors in bonds and other interest-bearing investments by offering them higher yield than they have seen in over a decade. Recession or not, increased costs have left many wondering, can they still retire when they hope to? With inflation higher, retirement will no doubt mean retirees need to have more set aside. Here you can see the amount needed at each age, assuming an inflation rate of 3% and investment returns of 5% to get you to age 95. Now, this is not inclusive of your Social Security or any pensions, but gives a good idea of how much money you would need saved to pull a corresponding amount from your investments each year. Under these assumptions, to retire at 65, you would need about 25 times the amount you intend to withdraw each year if you were to retire at 65. If inflation were lower though, or your investment returns higher, this number would drop dramatically. For example, if inflation were just 2%, near its historical average, and your investment returns 6%, you would only need about 17 times the amount you hope to withdraw each year to have a successful retirement at age 65. Now, it has no doubt been a tough couple of years, but with unemployment low and the worst of the interest rate hikes already occurring, there's plenty of room for optimism looking forward to 2023. Now, if you have questions about how prepared you are or need some help getting prepared for retirement, please do not hesitate to reach out to us via email or phone via the contact info in the description. Thank you so much, though, for tuning in, and we hope to see you in the next update from TimeWise Financial.